are myself and my partner, Jim Vincent. I will say that Jim is the most knowledgeable individual I've ever met in the field of real estate. What's fascinating is Jim built his fortune in real estate really in the 1980s in Calgary. And every day when we talk about the Phoenix market, he gets this sort of deja vu look on his face because really there's a lot of similarities. His background, he's been in the investing in real estate personally and through groups of investors since 1984, and has built a significant portfolio, not only buying single-family detached houses, which is how he first started in real estate, but commercial, multifamily, has real estate holdings around the world, as a matter of fact. And really Jim's forte is buying significantly below current market value and managing the property management companies. And that's what Jim's role is. Myself, I'm a financial guy. I've been in the financial services industry now since 1987. It's just a long time ago. And really my background is building financial products and services. I've managed Canadian sales operations for a $6 billion insurance and investment company, and have extensive knowledge in raising capital, but really building investment products and portfolios. When you come from the institutional side like I do, the real key is safety in the asset that you're building for an investment and cash flow. And really what we've done is we've taken that philosophy and applied it across the board in all the offerings that we've done at Capstone.
How have you aligned the founders and management with investors' interests?
Well, I think it's also important to align the founders and the managers' interests with the investors' interests. I think the best way you do that is through compensation. As I mentioned earlier, because Capstone does not receive a portion of the appreciated value of that asset until the investors receive back all their capital, I mean, that really aligns our interests with the investor. The other thing that happens is that we take no management fees to manage the portfolio on an annual basis, other than once we paid out the 6% bond yield through net rental income. So this is actually rental income. It's not a return of capital that we accumulated somewhere else, but net rental income. Capstone keeps the difference. What that means is we're motivated by buy a quality product, rent it for as much as you can, rent it on a monthly basis to quality tenants, because we fundamentally have to return that 6% yield before we participate in any annual cash flow. And that fully aligns our interests along with the investors' interests. And then of course at the end of the day, well, I mean, until we return all the invested capital back to the investors, we're not participating in the profits that we're generating through how we're buying those properties and how we're selling those properties.
What are the key downside risks, and how have you sought to mitigate them for investors?
Well, I think when you invest in any investments, a key factor is what are the risks. And by the way, every investment has risk. You take your money and you pop it under the mattress, you've got inflation risk. So we like to spend time talking about, well, what are the risks associated with investing, first off, in real estate, and specifically investing, in revenue-producing single-family homes. First risk is market risk. No matter what anybody tells you, nobody knows 100% when and how the market's going to react. We do a substantial amount of research. We do projections on supply and demand ratios. We have a good feel, but real estate markets specifically, they work through cycles. And as I mentioned earlier, the key to eliminating market risk is having time. So for us, that could be the risk. If that market doesn't come back, as we anticipate in the next 2 to 3 years and start showing signs of growth, we may be waiting a little bit longer. And from a time horizon standpoint for us, we really think our sweet spot's really 3 to 5 years to maximize our return, but it could take a little bit longer. Key to that is getting paid to wait, which is that 6% yield that we're really targeting. But the other side is that you have a risk when it comes to revenue being created through rental income, and that's really vacancy risks or occupancy risk. We think we're going to have a bit of a challenge later on in the offering when all of these individuals that are renting from us decide that they want to go buy their own home. And that's a bit of a challenge, because today our average rent per home is approximately $1,000 per month for an 1,800 square foot house. So it's not a bad deal. But believe it or not, because of the tax structure for these individuals in the States, you're much better off having a $1,500 mortgage and writing the interest portion of that off on an annual basis or a monthly basis versus having paying $1,000 a month in rent. So we've got a large number of people who, once they can qualify for financing, are going to go buy. That's the great thing about the offering, but you also have to manage what that vacancy rate risk is going to be. We think that's going to be a short period of time, but that's also the key for us, is saying, rather than trying to time the top of the market again, trying to sell for $150 or $200 a square foot, why would we not be selling into that escalating market, liquidating those assets fairly quickly, and realizing our gains? And so vacancy is definitely a risk, but we want to mitigate that through exiting the market as we start getting more and more demand coming into that market. I always find this interesting. 70% of our current renters were previous homeowners. So when those people can qualify for financing, we're going to have a huge number of people who are going to be eating up a lot of the supply in that market. So that's a risk. The other risk you want to be cognizant of is currency risk. We're taking Canadian dollars, we're converting to American dollars, and we're buying U.S. assets. And those U.S. assets are what are creating our cash flow. I also think there's currency opportunity, but if the Canadian dollar went to $1.20 at the time that we were looking at liquidating those assets, that would eat into our profit. On the flip side, if that Canadian dollar, we've averaged to, in Saguaro Series 2 about $1.02 to $1.03 for every Canadian dollar we spent to get a US dollar, so our currency conversions worked well. But the opportunity is if that dollar goes down to 90 or 95 cents, then obviously that changes what our rates of return are as well. But it's a risk. I mean, you want to be cognizant that if there's substantial currency fluctuation, the Canadian dollar really escalates in value against the US dollar, that is a risk. And liquidity. I think it's important to understand that when you buy a real estate asset, it's not a liquid asset. The dollars that you invest in Saguaro Series 2 should be dollars that you're looking at allocating for, as I mentioned, that 3 to 5 year time frame, and the dollars are not liquid, meaning you can't purchase Saguaro Series 2 and 6 months later come back and say, I'd just like you to sell a house so I can get some of my money out. Wouldn't be fair to the rest of the investors. So, it's understanding when you look at what kind of allocation you'd put into something like Saguaro Series 2, it should be an allocation that you're comfortable saying, you know what, I can leave that money and I can let it grow. I'm going to get an income off that capital through the net rental income that we're generating, but I'm not able to access my capital for a period of time. So liquidity risk is something else to consider.
What are the upside possibilities? How do investors benefit from that?
I think the real upside opportunity in purchasing Saguaro Series 2 is twofold. First, it's cash flow. I think that something that all of us have been searching for especially the last 10 years is, how do I continually increase the value of my portfolio? And honestly, the best way to do that is to have an investment vehicle that's paying you every single month to hold that asset. And we have a preference payout, 6%, through the bond component of the Saguaro Series 2. And that's a key. And by the way, that money is not generated through us taking the money and putting it to a side account and paying interest. It's generated through net rental income. So this is real cash flow. It doesn't affect the value of the asset, other than the more cash flow you get, the higher the asset value is, but it's being generated through that net rental income. The other side is capital appreciation. One of the positive things about what we've experienced in Saguaro Series 2 is because we've been able to buy at 20 to 25% under current market, we're in the money. I mean, if we had to liquidate the entire portfolio today, we could return all that invested capital back to the investor, and as well still have some appreciation that we would be sharing with that investor group. Now that really is a little bit focused on, for Jim and I mean, our motivation on how we buy is based on, we want instant equity. We want to be in the money right from day one. The best way for us to do that is to buy really well. If you calculate that we bought our average, right now we got 33 houses in the portfolio. Average square footage is 1,800 square feet, and the average price per square foot is just over $49 a square foot. You can sort of do the math. If our target is $100 start exiting at $100 a square foot, there's a substantial amount of capital appreciation that the investors will be participating in.
Overall, what type of returns are you providing to investors? Is it a yield, growth, blend, inflation hedge, or capital preservation tool?
Capstone specializes in real estate. That's our focus. That's what we've been doing since 2004, and that's where our skill set comes from. And I think it's really important to understand that by no means should you take 100% of your capital and put it in any one offering out there. I think that every type of asset class has a place in people's portfolios. My belief is that the vast majority of people are very underallocated to real estate. And real estate provides unique opportunities for investors. One is cash flow. I mean, cash flow is king. To have an asset where someone is going to pay you on a monthly basis just to have the right or the privilege to use it is extremely powerful. The other thing that you have to realize is that unlike a GIC, the great thing about rent is that you can increase rent with inflation. So you're bulletproofing an asset to some extent because you can increase rates as inflation rates go up. And by the way, fixed assets, when you experience inflation, also increase in value. And those are really important components of a diversified portfolio. The other thing is it's a real asset. I used the phrase earlier, you can kick the dirt. That's the great thing about real estate. You can touch it, you can see it, and it's there. And the other piece for us is that if you're going to do it well, you buy at the right time and you sell at the right time. And normally that's buying when everybody else is selling and selling when everybody else is buying. So if you're patient and you live on the cash flow and you target an exit strategy that provides that increased value when everyone else wants to purchase, it's one of the most secure assets there is, and it is extremely valuable in a portfolio to give you that constant return. And the great thing is, it sure takes a lot of the peaks and valleys out of investing.
You've been watching Enquirica TV. Enquirica is a Calgary-based firm focusing on independent analysis of alternative asset classes. Enquirica has an archive of general research across a broad range of topics and interviews with newsmakers and entrepreneurs about their perspective on the economy and their sectors, with a view to providing unique and timely information from a non-mainstream perspective.